Go to our first question here in Ottawa, and I'm going to call on Steve Shearer from Reuters, please.
Hi, Governor. Thanks for talking to us today. I'm a bit torn as to which question to ask. Let me ask this one. A few months ago, in January, you paused rates, and when you did, you indicated that it would be a pause. And since then, we've seen the housing market recover. And you said today in the statement that it's adding to inflation. Do you think that it was a mistake in your messaging in January to say that? Should you not have maybe just said, we're not raising rates today, but we're going to keep watching things?
Well, let me just remind you what we said in January and what the situation was in January. In January, we had over the previous 10, 11 months raised rates very forcefully. It was the most rapid increase in the Bank of Canada's history. And so it made sense to pause. We know monetary policy works with a lag. We knew it was going to take some time for those rapid interest rate increases to feed through to the economy. What we said at the time is, yes, we're taking a conditional pause to assess whether we've raised rates enough to restore price stability. As I said, I think that made a lot of sense over time. What we've seen in the subsequent 5 months is that I'd say for the first few months, data was coming in largely in line with our projections. But in the last 2-3 months, what we've seen an accumulation of evidence pretty consistent across a range of indicators that there's more excess demand in the economy. Excess demand is proving more persistent. Underlying inflationary pressures are proving more persistent. So in June, we raised by 25 basis points. Obviously, we've raised a further 25 basis points today. What we're saying now is that we're taking it one decision at a time. We've laid out our forecast for inflation. We've been clear about the indicators that we're following, and we're doing our best to balance the risks of under and over tightening.
Thank you. We'll now go to Najoud Al-Mallis from the Canadian Press, please.
Hi, Governor. Kind of related to that question. The new forecast for inflation suggests rates aren't going to come down anytime soon, or at least not the same timeline that people may have expected previously. Can you talk a little bit about what today's rate hike and the new projection means for interest rates moving forward, not just in terms of like how high they'll get, but in terms of the impact having elevated interest rates for longer might mean for the economy?
Well, look, the short answer is the same answer to the previous question. We're going to be taking each decision one at a time. We're going to have, we'll take each decision based on the best available information on that time. What can we say? What we can say is, what we see is that monetary policy is working. Inflation's coming down. We also know that monetary policy works with a lag. So we know that the full effects of the past interest rate increases we've already done have not fed through. We will be seeing that impact going forward. The other thing we're seeing, though, in the economy is that those underlying inflationary pressures, they are stronger than we expected. With the increase in our policy rate in June and July, our own forecast has inflation hovering around 3% for the next year, and then coming down gradually to the 2% target in the middle of 2025. So, what does that mean? I think it means that we think we're close, but what I would highlight is that there are a number of things that have to happen for that forecast to be realized. There are a number of things that have to happen for inflation to ease back to target. And as I mentioned in the opening statement, there are two that we're particularly concerned about. We're concerned that we've been surprised by the persistence of excess demand and underlying inflationary pressures. We know that increases are feeding through. They're having an impact, and there's more to come. But what the total impact of those interest rates is ultimately is uncertain. And then the other thing is, in our own forecast, inflation hovers around 3% for the next year. What that's telling you is the downward momentum in inflation is waning. And we are concerned that, if we're not careful, the progress to price stability could stall. And if you get some upward surprises from there, inflation could even move back up. So we've been clear about the indicators we've been watching. I think it's clearly too early to be talking about interest rate cuts. We are certainly trying to balance the risks of over and under tightening, and we'll be taking it one meeting at a time.
Next, I'll call on Rahul from Epoch Times, please.
Thank you for taking my question. Regarding the box on household financial health and the strength in consumer spending, you say there's a smaller portion of households who are experiencing financial stress and that many households remain healthy. In a way, it sounds too good to be true, but I would think this is contributing to the consumer spending, which remains strong. But how does this match up with other reports of more than half of Canadians being less than $200 away from being able to pay their monthly bills, and does that factor into the Bank of Canada's decision to raise rates again because you feel that household financial stress is limited?
Well, I mean, Ro, we see some of the same headlines that you see, that you're talking about. And it's one of the reasons we did the work that contributed to the box you're referring to in our monetary policy report. We wanted to take a bit of a deeper dive. When we're looking at our forecast and in general, the work we do, we deal a lot in sort of aggregate numbers and averages, but we know that inflation and interest rates, the response to inflation, affect people very differently. And in particular, we know, we have said this many times, we know that the most vulnerable Canadians are the ones that are hurt most both by inflation and by higher interest rates. So that's what that box was designed to do. We also survey Canadians, and we've included some of the feedback we get in our surveys in our monetary policy report. But what we're looking at in that box is the data. And really, there's two things that we think are helping buffer many households from both inflation and interest rates, and that is the savings they accumulated over the course of the pandemic. You can see 3/4 of households have accumulated quite a bit more savings than they had prior to the pandemic. And then the other thing that we think is supporting basically confidence and buffering Canadians from some of the impacts is the strong labor market. People feel confident about their jobs and their income, and many are seeing wage increases. So we definitely think those two things are contributing both to reducing the financial stress for some, and also contributing to that consumption that we talk about. But we are acutely aware that this is a very difficult period for some Canadians, and interest rates and inflation are making things very difficult for some.
Paul Vieira of the Wall Street Journal, please.
Governor, in the statement, I'm sorry, I'm just going to I want to get the exact wording. In the statement, it said, the bank said that officials were concerned that progress toward the 2% inflation target could stall, and thereby jeopardizing the return to price stability. If that was the case, why did officials discuss the possibility of holding rates at this meeting leading up to the July 12th? Why was there even a consideration, given some of the warnings you put in the statement and in the new economic outlook?
Well, Paul, I think that really reflects the fact that we're trying to balance the risks of under and over tightening. We know that if we don't do enough now, we'll likely have to do even more later. We also know, though, that if we do more than we need now, it's going to be unnecessarily painful. So when you deliberate, you want to look at the options. I think strategically, the Governing Council was very much of the view that monetary policy was not restrictive enough. We also we discussed, does that mean we should raise now, or should we gather more information and confirm that? I think there was a clear consensus that we didn't see a big benefit of waiting. We were pretty convinced that we needed to move up because of the persistence of excess demand and the persistence of these underlying inflationary pressures, and the risk that if we need to keep getting inflation gradually moving back to the target. If it stalls and we get some upside surprises, things could be more difficult.
And Paul, I'd add, it comes back to Raul's question that he just asked. We are acutely aware that these decisions have real impacts on Canadians, so we always debate the options, and we never make a decision lightly.
Okay, I'm going to call on Mackenzie Gray from Global News now, please.
Hi there. On housing, in the report you say that high prices are likely to persist and boost inflation. Two things on that. Why do you think house prices are going to continue to rise? And secondly, how much do increased house prices weigh in your decision making on increasing rates or potentially keeping them at a higher level for longer?
Well, the short answer to why house prices keep going up is supply. We've said that for a long time. There's lots of things that go into house prices. Certainly, housing is very sensitive to interest rates. So when interest rates move, it affects house prices. But one of the fundamental things that's holding up house pricing in Canada is there's just more demand than there is supply. One of the things that's contributing to the demand for housing now is an increase in population. We've seen a return to immigration levels that we had pre-pandemic, and quite a high surge in immigration more recently. So those things are contributing to keep housing prices high. Housing is a component of overall inflation, but we target inflation. We don't target house prices, and we don't target any one sector or one item within the CPI basket.
Mark Rendell, Globe and Mail, please.
Thanks for taking the question. In terms of the growth outlook, it looks like growth in the second half of the year and in the first half of next year around 1%. That doesn't look like a contraction. We still haven't got that recession that people were talking about last year. Based on the new growth forecast, is this a soft landing scenario, or is a recession still a possibility on the cards?
So, as you said, we've got growth, demand in the economy has surprised us on the upside. You can see that our growth forecast for this year is revised up. We still think, though, that the increases in interest rates are feeding through to the economy. We still think growth will slow. As you indicated, we think growth is going to average around 1% for the next year before picking up after that. So what that's telling you is, in our forecast, there is a path back to price stability while maintaining growth. So there is no recession. We need a period of growth below trend, below potential, to let supply catch up with demand. That's what's going to relieve those price pressures. But we do think that there's a path back to price stability with the economy still growing.
Okay, next I'm going to call on Greg Quinn of Market News, please.
Good morning. Why didn't the first 8 hikes in interest rates, including the 100 basis point move last July, do more to slow down the economy? And does this suggest there's something still missing in your modeling or in monetary policy beyond lags?
Well, Greg, I think we have to be a little bit humble about exactly how the monetary transmission mechanism is working. But I think what we see is that monetary policy is working. Inflation has come down a lot. It was 8.1% last summer. It's 3.4% now. So it is working. And if you look under the hood, you can see that it's working where you'd expect it to work. I mean, when we raised interest rates, we saw housing slow quite sharply. You're seeing most interest-sensitive goods, so things that people buy on credit, household appliances, furniture. You have seen demand for those things slow. But it is true that they haven't slowed as much as we thought they would. Housing activity has ticked back up. Durables have slowed, but not as much as we'd expected. So why is that? We think basically that there's 3 things that are providing more underlying support to demand in the economy. First of all, the labor market remains tight. The unemployment rate, it has ticked up a bit, but it's still historically low levels. Wage growth's been running 4 to 5%. That's above what would be consistent with achieving price stability. We're seeing some easing in the labor market, but it's been more gradual than we expected. The other element, Carolyn already mentioned, most households have accumulated savings through the pandemic. That may be buffering them from the effects of inflation and higher interest rates on their budget and supporting consumption. And the third element is population growth. Population growth has increased. We've had a big increase in immigration, more temporary foreign workers in the country. That's adding both to demand and supply. On the supply side, you can see that's a factor that's easing some of the labor shortages and is supporting, what you do hear from companies, from firms, is that labor is more available. They are filling those jobs. Vacancies are coming down. Some of the pressure in the labor market is gradually coming out. But those new entrants into Canada, they're also new consumers, they're new renters, they'll probably ultimately become new home buyers. So that's adding to demand as well. So we do think monetary policy is working, but there is just more underlying strength. And so it's got to work a little harder and it's going to take a little longer, as you can see in our forecast, to relieve those price pressures.
Okay, next on my list, I had Annie Bergeron-Oliver from CTV.
Hi, thank you very much for taking our questions. I'm just wondering what your message is to middle-income Canadians who feel frustrated and feeling the daily pinch of high interest rates, whether it's trying to buy a new car or buy new furniture on payments. And this is only made worse by high inflation, especially when it comes to food.
Look, I understand that we understand that there's no easy path to restoring price stability. We understand that inflation's a burden on Canadians, and we also understand that higher interest rates are squeezing many Canadians. You asked me what's the message. I think there are three key elements to the message. The first is inflation has come down a long way since last summer. And that means the cost of living this summer is rising a lot more slowly than it was last summer. And that is welcome relief to Canadians. But the second message is we know Canadians are still coping with large price increases for many of the goods and services they buy. And that's particularly affecting lower income Canadians, because they have the least ability to afford it. One way to see this is if you look at the proportion of the goods and services in the CPI basket that are rising faster than 5%, it's a little over half. I'll say that again. A little over half the components of the CPI basket, their prices are rising more than 5%. So what is that? Well, if you look across the basket, meat's up 6%, bread's up 13%, coffee's up 8%, baby food's up 9%. If you look at food overall, food in stores overall, it's up 9%. Rent's up 6%. If you look at, there's also a range of other services that are over 5%. If you're planning to take a family holiday this summer, hotel prices are up 13% from last summer, restaurants up 7%. So, what is inflation? Inflation is a generalized increase in prices. And when you look across the basket that Canadian households are consuming, they're still seeing, too many goods and services with price increases. So the third part of the message is to relieve those price pressures. Yes, we do need to slow demand in the economy. That's what's going to relieve those price pressures. And the way we do that is we raise interest rates. We know it's difficult, and we are doing our best to try to balance the risks of over-tightening and under-tightening. We are committed to restoring price stability. That that is a benefit to all Canadians. We don't want to make it more difficult than it has to be.
OK, je vais demander maintenant si Francis. OK, Francis
Francis
Bernier,
Hébert.
indépendant.
Independent.
Bonjour, merci de prendre ma question.
Thank you for taking my question.
Vous dites que le marché du travail est
You're
encore très
saying that
serré puis que
the labor market is still
les
very
augmentations de
tight.
salaire sont encore très élevées.
Wage
Mais bon,
increases are still very high.
ça s'est quand même relâché dernièrement
But it
beaucoup.
did
Est-ce que vous
slow down
pensez qu'on est
lately.
près du but,
Do
encore
you
très
think
loin
that
au niveau du marché du
we're
travail?
close to the
Ça
target?
commence.
When it comes to the labor
L'ajustement
market, it's starting.
commence. Les postes vacants ont
Vacancies
diminué.
have been
Ils étaient
reduced.
très élevés. Ils
They
sont
were
encore
very
élevés,
high.
mais
They're
un peu
still
moins
high, but a
élevés.
little less.
Si il y a un graphique
there was a
dans le
graph,
rapport sur la politique monétaire qui montre
There is a graph in the monetary policy
le taux
report
de
that
croissance de
shows
main-d'œuvre relatif au taux de croissance de population. Et
labor force
après
increase
une
relative to the
période de
increase in
temps où le taux de
population.
croissance main-d'œuvre était beaucoup
There was a
au-dessous
time where it was
de
much
croissance de
higher,
population, maintenant
but
c'est un peu
now
en
it's
dessous.
a little
Donc
less
ça
than the
suggère
growth
que
in population. So that suggests
il y a l'ajustement dans le marché de
there's an
main-d'œuvre commence.
adjustment in the
On
labor
anticipe
force. We're anticipating
avec le ralentissement
that with the
de
slowdown
croissance, du demande dans l'économie,
growth and
on
demand in the
anticipe
economy,
on verra
we will
un
see
marché de main-d'œuvre
the
mieux
labor force
équilibré
be
et
better balanced.
après un bout de temps,
after
le
some
taux de
time,
croissance des salaires va diminuer
wage growth will
cohérent avec
diminish
notre
accordingly.
cible. Ça va prendre du temps
It
et le
will take
message
time.
dans notre prévision, c'est cet
In our
progrès
forecast,
est un peu
we
plus
think that this
lentement
will
que
be
prévu.
slower progress than anticipated.
Okay, and our last question in the room is from Randy Thantong Knight of Bloomberg News, please.
Hi, Governor and Deputy Governor. What are your thoughts on the current high levels of immigration that we're seeing? Do you see it as being more inflationary or disinflationary in the short run?
I mean, the short answer is that on net, it's probably roughly neutral, but it's affecting different parts of the economy differently. So, we're starting with an economy that's in excess demand. The economy's overheated. The immigration adds supply. It adds new workers. Immigrants coming, many of the immigrants coming in, the labor market's very tight. They're finding jobs very quickly, some taking a little longer. But, what we're seeing is the labor market is snapping up those new workers pretty quickly. That's adding to supply, and that is easing some of the labor shortages, the pressures in the labor market. And if you can ease the cost structure cost structure for companies, that helps ease inflationary pressures. On the other hand, these new immigrants, these new entrants in the economy, they're also new consumers. They're new renters. They're new home buyers. So it's also adding to demand. It's hard to know exactly what the net effect is, but I think the main message is that it's adding to both demand and supply. If you start in an economy with excess demand, you add both demand and supply, you're still in excess demand. And what we're seeing is that the excess demand in the economy is more persistent than we thought. And so it's taking, we've raised rates in June and July, and it's taking a little longer to get inflation back to target.